This segment is proudly brought to you by 3P, the Wealth Creators, and Home Edge Finance, our experience, giving you the edge in home and commercial lending.
Yes, Ziggy here, and welcome to the finance segment Money Does Grow on Trees on GRTV. On the show, we cover all things money, and we welcome your questions by email. The question that's selected to be covered on the show will receive a free copy of my book, Money Does Grow on Trees. This week's question comes from John in Marrickville, Sydney, and he says, Ziggy, thanks for a great show. I want to say I'm concerned about the risks with investing. Thanks for contacting us, John. What a great question. Once you've selected a financial advisor, you will get asked a series of questions, and a set of those questions will relate to your risk profile. All investors have a different attitude to risk. When it comes to investing, it is important to consider your risk profile or tolerance carefully, including how comfortable you are with the possibility of losing money or that the returns on your investment could vary widely from year to year. Understanding your personal risk tolerance will help you choose an appropriate asset allocation. And the idea of determining a risk profile is to help you determine the investment mix that's appropriate for your needs. To establish an investment strategy that you'll be comfortable with, you need to consider the possibility that the value of your investment may decline, even though this may only be temporary. So questions you need to ask yourself: are you prepared to accept the possibility of a negative return at any time in exchange for potentially higher longer-term returns? And what percentage of your money would you be prepared to invest in higher risk investments? To help you answer these questions, work through the following 4 points to determine which is important to you. Do you want to avoid short-term losses? Do you need to receive regular income from your investments? Do you want long-term growth in the value of your investments? Or do you just want your investments protected against inflation? Between 2008 and 2012, the stock market fell more than 30%. Now, if you owned an investment that fell by 30% in a short period of time, what would you do? Would you sell all the remaining investments, making you conservative? Would you sell a portion of the remaining investment, making you conservative to balanced? Would you hold the investment and sell nothing, making you a balanced or aggressive investor? Or would you buy more of the investment, making you an aggressive investor? It all comes down to your age and your investment horizon. Because if you're going to need access to your investment sooner rather than later, then it makes sense to be conservative. And likewise, if you have plenty of time before you need the money, then it makes sense to invest in growing assets and actually take some risk. In concluding, however, I do want to give you a word of warning, because grand plans for retirement may not be achievable if you have a conservative risk profile. Bear in mind that maybe you won't be able to achieve all your objectives in life unless your investments engage in a little risk in return for higher investments. Now, I'm not suggesting you don't have dreams. In fact, I encourage that, but you do need to be realistic. Well, that's the end of the segment, but before we go, here's this week's funny finance phrase. An oil sheik says in a gallery, "I really admire Picasso. There is nobody who was able to sell oil so expensive." Remember to email your questions in, and if your question is covered on the show, I'll send you a free copy of my book, Money Does Grow on Trees. John, thanks for your question. A copy is on its way to you, my friend. On behalf of GRTV, I'm Ziggy, and remember, money does grow on trees. Yassas.